Hey Bowtie Nation, Joseph Hogue here, and if you remember last week, I showed you how the stock market is absolutely wrecked by just the top 7 stocks. Index funds like the Spider S&P 500 ETF, the SPY, with more than $400 billion in investor money, are not index funds at all, but just a bet on 7 stocks. That's because those 7 stocks are now nearly 30% of the index and priced at over 33 times their earnings. A nosebleed level of expensive relative to the 21 times PE average for the remaining 493 stocks in the index. That all means funds based off that index, the S&P 500, like the SPY, and the Vanguard 500 Index Fund, the VOO, are going to have a very difficult time repeating last year's returns. And that means you need a different index fund for 2024. In this video, I'll highlight 5 ETFs and index funds, how to use them in a portfolio, and the index fund I'm buying in 2024. And I'll start with one of the best replacements for your index fund exposure, the Vanguard Small Cap Index, ticker VB. This fund holds shares of over 1,400 companies with a median market size of $6 billion, which is still pretty darn big, but much smaller than the mega-size $195 billion companies in the S&P 500 index. Stocks here are also much cheaper at just 14.6 times on that price-to-earnings basis versus 23x multiple on the S&P 500 stocks. So these smaller companies not only have more room to grow for those higher returns, but also give you a solid value tilt in your portfolio. You pay a low 0.05% fee to hold the fund and collect 1.7% dividend, higher than the 1.4% average dividend on that S&P 500 index. And here you're still going to get that exposure to growth stocks like tech in the small cap index fund, where the sector is almost 13%, along with consumer discretionary at 16%. But overall, it's just a more diversified across sectors than that larger index. And within that 1,400 plus stocks, you don't have to worry about any one destroying the fund like you would with a crash of that Magnificent 7 in the S&P. Here, no stock is more than 0.4% of the fund, so it's much better spread out across stocks. It's a really strong contender if I were going to buy just one index fund, but got edged out by another fund that I'm going to show you later. By the way, if you ever want to see exactly what stocks are in an ETF or an index fund, you can always go to its website and look for either portfolio or holdings here in the menu. It's going to show you exactly the sectors as well as the individual stocks. It's also a great way to get ideas for stocks to buy if you want investments in a specific theme. Now, if you want to see which stocks are in my portfolio, check out the link to the Blossom app I'll leave in the description below. Blossom is the social media app we've been waiting for, made for investors only for investing. Click through the link to see my portfolio and get ideas on your own. I know a lot of you like those income ETFs like the QYLD and the JEPI, so I wanted to highlight a newer one here, the iShares Treasury Bond Buy Right Strategy, ticker TLTW, with its 17.8% dividend yield. Now this isn't an index fund, but I'm going to explain later while I'm including other ETFs or exchange-traded funds, along with a strategy on how to use both. With non-index ETFs, you're going to get the opportunity to target your portfolio into themes like growth or high income or dividends like this one, the TLTW. This fund started trading in 2022 and uses a similar strategy to that QYLD, except with safer long-term treasury bonds. You can see here, it leverages up to hold 102% exposure to that treasury bond ETF, the TLT, collecting a 3.5% dividend on those assets. Then it sells a call option each month. This January 2024 call option with a strike of $99 on the TLT to collect that premium cash and then boost the dividend. Now, like a lot of those income ETFs, you're probably going to see some price depreciation on these, so your total return is likely going to be under that 17% dividend yield. But if interest rates do fall in 2024, then this one could do very well. Unlike the QYLD, which holds those NASDAQ 100 stocks and is going to fall when the market falls, Treasuries are a safer investment and will only fall if interest rates rise again. This next fund, the First Trust Cybersecurity ETF, ticker CIBR, gives me exposure to one of my favorite long-term growth themes. Cybercrime costs have jumped fourfold over the last 3 years and are expected to double again through 2027. And I'm thinking here with the rise of artificial intelligence and how much reliance we're going to be putting on software, cybersecurity needs could still be underestimated. The 32 companies held in the fund are all big names in cybersecurity, with a median market size over $10 billion. You've got pure play names here like CrowdStrike, Palo Alto Networks, and Zscaler, along with broader net names like Broadcom and Cisco. We're just getting started here, but I feel like there's a big misconception out there between index funds and ETFs, or those exchange-traded funds. Now, I'm highlighting both in this video, but there's a very important difference. An index fund is a passive group of investments bundled together, and then shares of the entire group are sold to investors. buying a share of the fund means you get the returns on everything in that group instead of having to buy hundreds or even thousands of stocks separately. And for this, you pay a small percentage fee to the manager. Now, this might sound a lot like an exchange-traded fund, an ETF, and it's because index funds are sold as ETFs or mutual funds. You buy them just like stocks, and most you can buy with no commission. Now, where the confusion sets in is not all ETFs are index funds. You see, index funds invest across a broader benchmark group like the S&P 500 or the NASDAQ. The manager is just replicating what's in that index, so they're investing passively and really have no control over what goes into their fund. That's different from a lot of the theme ETFs, like for example the Vanguard High Dividend Yield Fund, ticker VYM, which I do also like, but is not a true index fund. The VYM, like other non-index funds, bases its investments off a strategy or a theme, in this case companies that pay above average dividend yields. By comparison then, the S&P 500 is a broad stock market index. The NASDAQ 100 is a broad index of the 100 largest non-financial companies listed on the exchange, so more broadly defined and inclusive of all stocks in that group. Okay, I know by now half of you are screaming, get on with it already, but the difference is hugely important, and I want to explain why every investor needs an index fund in their portfolio. So buying an index fund just means you get that broad market exposure. You are the market, and you know you're going to get all the diversification and the return you can only get with the entire market. Now, ETFs focused on dividends or growth or some of the themes I'll cover here are also critical to your portfolio, but investors don't realize what they're missing when they only buy these hot ETFs and not a true index fund. To show you that, let's look at the Vanguard Dividend Fund, the VYM, versus a true index fund, the Spider S&P 500 Trust, the SPY here. The VYM holds almost 500 stocks, so you'd think your risk is spread out really well. But if you look at the weight of each sector in that fund, the picture starts to change. The stocks in just 4 sectors, consumer staples, energy, financials, and healthcare, make up more than 57% of that fund. Just 4 of the 11 sectors of the economy are more than half of that fund. And when you compare those stocks in the VYM with the S&P 500, what most people use as a benchmark for the overall stock market, it is a completely different picture. For example, more than 27% of the S&P 500 index is in tech stocks, while the group only makes up 6.9% of that VYM ETF. Energy stocks make up 10% of the dividend fund, more than twice the exposure in that overall market. And I know it might seem like a big nothing burger of a difference, but it will be critical to your portfolio having at least one index fund along with maybe a few theme ETFs to give you that broad market exposure along with growth or dividends in that theme. In our next fund here, you can see what kind of hell the iShares Clean Energy ETF, the ICLN, went through last year, down more than 20% for the year. But renewables and EV could be a major theme for 2024 on those lower interest rates by the Fed. Not only did higher rates hit valuation multiples on growth stocks, so the price investors were willing to pay for those future cash flows on these stocks, but higher rates also made the debt that those companies and consumers use to finance clean energy products like solar more expensive. It was a double whammy that destroyed a lot of these stocks over the last 2 years. But with the Fed expected to cut interest rates as many as 6 times in 2024, here seen in this market expectations on the CME FedWatch tool, the stocks in this fund could find themselves rebounding back into that easy money policy. The 101 stocks held in this fund trade for just 14 times earnings, despite a lot of these being strong growth companies with double-digit sales growth each year. These are names like Enphase Energy, First Solar, and Sunrun that boomed after the pandemic. There is no doubt that we are heading towards a more renewable energy world, and these will be the companies that benefit. Investor sentiment is highly cyclical for renewable energy stocks, and if we are at the trough of this cycle, the returns here could be some of the best you see over the next couple of years. I'm going to reveal that index fund I'm buying for 2024 next, but the most important question here is going to be how to use these index funds and the ETFs in your portfolio. I know that might seem like an obvious answer, but there is a special strategy to using index funds that will give you all the safety and long-term returns of the market, but also the upside potential for individual stocks. And all you out there in the nation know I'm talking about the core satellite strategy. We've talked about the core satellite strategy before on the channel, my favorite way to invest, and a strategy that's going to save you hundreds of hours. The ETFs and index funds here, these are going to make up that core part of your portfolio. You're going to have 50 or maybe even 60% of your money in just a handful of funds. It's going to give you those market returns and the broad returns on these major trends. So if you're using this strategy, you really don't even have to choose among the 5 ETFs or index funds I'm listing here. You can buy each for that complete core portfolio that covers the market as well as these developing themes. Then with the rest of your portfolio, that 40% left over, You invest in 10 to 15 individual stocks you really like with the chance to outperform the broader market. With this strategy, you'll never have to worry about that ETF portion of your portfolio because it's diversified across hundreds or thousands of stocks. That gives you a simple, stress-free strategy and frees up time to research those individual stocks for even higher returns. But the index fund I'm buying, the one that solves the problem of the Magnificent Seven, the Invesco S&P 500 Equal Weight ETF, ticker RSP. So instead of weighting each stock by its company size, the RSP holds an equal amount in each stock of the S&P 500, spreading the exposure out evenly across the index. So you keep that index exposure to the largest U.S. companies, but across all of them. That equal weighting also clears up some of the sector level problem in the index, dropping tech stocks from 27% of the group down to 13%, and communication services from 9% to just under 4%, while some of the other sectors here get a little more exposure. Now the fund is going to tilt your exposure towards those smaller companies since they have a higher weight than in the regular S&P 500 index, but even the smallest company, Fox Corporation, is still a $13.8 billion giant, so this is still very much a large cap fund. Even better though, because those big tech companies that are overweighted in the traditional S&P 500 index are just lousy for dividends, the RSP ETF pays a higher yield at 1.7% versus the 1.4% average in the market index. It's just a great way to keep that index fund safety, get market returns, but without putting all your portfolio to risk at just a handful of stocks. See the stocks in my portfolio and get more ideas on your own with the Blossom app with the link below, or click on the video to the right for my complete 2024 investing plan. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.